One of the most instructive and oldest businesses on the Australian stock market is WH Soul Pattinson, better known as Soul Pats. In its latest half-year profit today, it shows assets up 10% to $11.5 billion. Its investor return, including dividends, is 8.3%, and that's about 2.4 percentage points better than the All Ordinaries accumulation index. Now, that's the measurement Soul Pats relies on, not the normal profit or loss account, so it judges itself on that. Its chief executive is Todd Barlow, who joins me now. Todd, many thanks for your time. Trying to achieve that sort of a return above the index during a time when the market is so choppy, when, companies are struggling again with inflation and with growth. Is that a difficult thing to attain?
It's always difficult to beat the market. It's something that is the torture of being an investment manager. How do you do better than the rest of the market? We've been very lucky. We've been able to outperform for a very long time. If I look back at the 20-year history, we've done about 3.5% per annum better than the market. And if I just look at the last 12 months, as you mentioned, our portfolio is up 10%. On a total return basis, that's 6% better than the market. That's very pleasing because generally we do very, very well in down markets because of the defensive qualities of our portfolio. What we saw in the last half was a market that was racing away, and as you mentioned, we did 2.5% better than the market in the last 6 months. So it was a real pleasure for us to be able to be nimble enough to adjust to the market changing and get ahead of that and actually beat the market in a rising market.
I talked about the $11.5 billion worth of assets. Is it easy enough to be able to move this portfolio around quickly? Like a person sitting at home here has got a portfolio. They can move in and out of the stocks pretty quickly and be pretty nimble if they're smart enough to pick the right ones. With $11.5 billion at very big positions, have you got that same flexibility?
It's not as easy for us with a portfolio that size, but I would say that we're very active. So we did $2.4 billion of transaction activity just for the 6 months. That's about 77% of the portfolio activity we did in the entire previous year. So the activity is definitely picking up, and that's in response to the market dynamics that I mentioned. So we can be very active, and we've been very active for a couple of years now in redeploying our assets into more private markets transactions, private equity and credit in particular. But also our public markets portfolios in large caps and small caps have been very, very active.
Okay, so I know historically that Soul Pats has said that it will generally do better when markets are falling because A, you can pick the eyes out of the market, and B, you can pick big positions in undervalued stocks. Is it harder, as it has been in the past 12 months, outperforming when markets are rising?
I think it is harder to do that because particularly when the market's dragged up by tech stocks, and if you look at the US market in particular, those are investments that are very difficult for us to value. High multiple, high growth businesses in emerging areas, that's not really our style. We tend to focus more on traditional valuation metrics, things with hard assets, things that have got proven business performance that we can understand. So those businesses are always going to be more robust and resilient in down markets. And when everyone's getting excited and paying high multiples, that is a lot harder for us to beat. But as I said, we've done a remarkable job in the last few years when the market's actually been performing very well.
Okay, so there's one other class of asset right now, private equity, where a lot of other investors have gone to. You've created some private equity positions inside your own portfolios by effectively setting up your own private equity investment funds that you invest in. So is that almost an answer or a response to try and get that outperformance inside this portfolio as well?
Well, private equity has always been a feature of the Soul Pats portfolio. If I think about some of the largest positions that we have in the portfolio today, like TPG and New Hope, they started out as private equity investments in our portfolio. They grew to a level where we put them into the public domain and floated them off and gave our shareholders some shares and we just retained a stake. So we're trying to replenish the private equity portfolio over the last 5 or 6 years. And we found a few themes that we're really focused on building, and I'm pleased to say in the last 6 months we're so confident in those themes that we've been adding to them, and every one of our major investments has attracted capital for growth purposes.
I've only got about a minute or so, but those themes, agriculture, trying to electrify the mining industry, which is another one as well, but there's a few other aspects that you've gone towards. Why did you pick those themes particularly?
Well, we started out by thinking about what is Australia good at, and we are good at obviously agriculture. You mentioned it's one of our best competitive advantage industries. We're good at finance, so we're in the wealth space. We're good at education. We picked up on that through our swim schools. And the energy transition is something that is obviously very meaningful here, particularly with our commodities exposure, and as you mentioned, the electrification of remote mine sites. So they are the themes that we picked. We also think about long-term demographic tailwinds, which are affecting a lot of those businesses, and that's how we kind of picked the themes, and we've successfully made investments in each of those key thematics.
I'll tell you what, it's always good to have you in the program, Todd. It is such an interesting and certainly a very old company as well, and it's one of the reasons why we try and keep a track of it. Many thanks for your time today.
Really appreciate your time. Thank you.